Chala, Mama Chala. I have you. Kateno lange wati please.
Ekitegeeza kati eno era okola ebintu bye bimu.
One direct material. Akwate not dividing by this. Enough na answer. So akifuna na times.
Guys, welcome back. So sorry about the network, but we're about to finish. So back to what I was saying, flexing of the budget. I already said that you're looking at, you had a fixed budget of 30, and it's different from the actual, which is at the level of activity of 40. Please kindly remove your video. What is this? Jackie, please. So I was saying that you want to make two tall gentlemen, okay, and then you compare them together, okay. So in comparing, in doing that, we are saying you flex the fixed budget, and we are saying the main thing about flexing is you just look at the items under the budget, which ones are variable and which ones are fixed, then which ones are semi-variable. Okay, so unfortunately or fortunately, you don't have semi-variable in this question. You only have fixed and variable. So for the variable, shortcut, anyway, to just cut the long story short, you just get the cost per unit. Okay, you want to know how much you spend on a single unit in terms of that particular item, and then always multiply with the level of activity. Okay, so just take it back to material for those who missed out. You're saying material by nature will not direct this production, and these are variable costs. They change with the level of activity. So our intention is to get the cost per unit, and I'm saying the cost per unit, just like you saw the selling price per unit, it's given by the total cost divided by the level of activity or the number of units. Okay, and I'm saying in this case our total cost for direct labor it is 3M. Level of activity is 30. You're getting 100. So this is the cost per unit. So what is the cost when the level of activity is not 30 but rather 40? You're saying it's 100 times 40,000. As simple as that. Okay, so it's 100 times 40,000. Now determine the variance. The variance, you're comparing the actual, which is saying it's new, then minus the old. Okay, 200. Is it favorable or unfavorable? You're saying these are expenses and the actual is higher than the standard. So we are being wasteful here. Hence, adverse or unfavorable. Okay, so now let me look at the fixed item and then call it flexing, unless you have any other question or a personal question. But ideally, that is it. So let me share, say, a fixed item. Okay, so direct labor will not vary differently or will not vary from direct material. The way you did it is the way you do it. Then variable overhead is the same thing. The way you did for material, you do it the same. Gross contribution. Gross contribution, you don't do anything. It's not an item of flexing. You just get the sales minus the total cost so far to get the contribution. Okay, then variable cost. Variable selling is the next. It is variable. That even helps you out. I've told you it's variable. Hence, get the total cost divided by the level of activity to get the cost per unit. Then for you to flex, you're saying it is cost per unit times the new level of activity is 40. Then you're good to go. Net contribution, you're saying it's not a computation. Yes, you're saying it's gross minus the variable. Then you have fixed production. Now, fixed production for budget it is 1.2 and actually 1.2. So you can go now flexing and do that. Okay, we have fixed production. 1.2 here, then it was 1.2 here. Okay, so flexing, how do you flex this? For fixed, it is fixed. You don't do anything. fixed costs do not change with the level in activity. So if you had a fixed budget of 1.2, it must remain as 1.2. Okay, then our variance will be a 0 here. New actual minus flexed. So you can't comment. So we can look at another fixed item, which is still in the question. Okay, maybe I can respond to some of the chats for so far. Let's see for what someone is saying up there. Kindly pardon on the comment. Okay. But I think I went off. How do you treat the fixed cost? It's what you're doing, Sito. I'm seeing it. Then kindly pardon on the comment. Okay. Then on the sales, we have favorable because we sell or we earn. We sell, we earn, hence favorable. Over there is another explanation. Just the expression is because a sale is an income, it increases your profits. The more the sales, the higher the profits. What you call maximizing sales or revenues. Okay, the more the sales, the more the profit, or the profit is maximized. That's the only reason. Hello. Okay, guys, I'm really sorry about the network. Okay? But to answer a few questions, I had answered, I think, Justin's comment and question. Then was yes, Sito. So we're saying for fixed, the thing is that you bring the budget the way it is. It was 1.2, then the actual was 1.2. Now on flexing, we're saying fixed don't change. Okay, so it will remain the same. They don't change in a level of activity. Okay, so I can give you another example of fixed like it was here, just to clarify on that. Here, I say that fixed selling costs, you have 1.1 for budget, and then you have 700 for actual. Okay, so you can look at it, 1.1. 1.1, then actual 700,000. Okay, so selling. Okay. And they said actually fixed selling. Selling cost. Okay, so I'm saying when you come to flex.
Excuse me.
Flex is saying fixed is 1.2. Therefore, the flex, because whether the level of credit changes or not, it's not affected. You still have the same as 1.1. The same figures. Okay, then you compare the actual, which is saying it is actual. Yes. I can hear you.
Up on the direct material. Up on the direct material, you got actual minus flex budget. You got 200. Why did you have to say it's advanced?
Okay. So for adverse, I thought we already talked about that. We're saying that as long as it's a cost expenses, as long as it's a cost, if your actual cost is bigger than the budgeted, it is adverse. The reason is that as a firm, you want to maximize profits. For you to maximize profits, you're saying you have to maximize revenues and minimize costs. So where your actual is bigger than standard, it means that for you, maximizing costs. And therefore, you're not actually maximizing our profits. That's why we're saying it is adverse. Okay, Jackie, I don't know if I've answered you or not, but I think I've answered you. You can feel free to ask for any clarity. Okay. So for those who are asking about the fixed, I hope I've answered you. I can now respond to some of the chats. Saying, is the number of goods sold fixed? The number of goods sold is the number of goods sold. That's what we call level of activity. It's not even supposed to be in the budget. Yeah, it's not supposed to be in the budget. What's in the budget is supposed to be only money. Only money. Is it revenues and sales? Are they costs you're spending? Yeah, that's the only thing that's supposed to be in the budget. Okay, the level of activity is just there for, it's not part of the budget ideally. So why are you putting the 400,000 in brackets? I'm not putting it in brackets. I'm just saying that actual minus flexed, you're getting a negative. Okay. Variance is new minus old. In this format, when you're flexing the budget, it's new minus old. Leave alone what we're doing for standard costing variance. Okay. And as you're going to see, the comment is not based on the negative. The comment is based on that the actual you spent 40,700 and yet you had budgeted 140. Meaning that for you doing well, you're spending less, you're minimizing your costs. So every time you minimize costs, you're actually maximizing profits, which is a good thing, and you're saying it is favorable. Yeah. I hope I've answered, what was the name of this one? Putting Dia. I hope I've answered you. Maria, I hope I also answered you about the number of units. It's the level of activity. It's not even supposed to be part of the what? Or the budget. However, we need it for clarity that what you're comparing here is not based on the 30 and the 40, but rather on the 40 and the 40. That's why you have the units here. They're not part of the working. Okay, let me even put a line here. Okay. Okay, number of units. These are the number of units. The units, it's not money. Okay, they just help us to get the money this side. Okay, maybe to answer then there was Justin. Kindly re-explain for me sales being favorable, my network goes off. Justin, you're saying as a business, we want to maximize revenues. When you maximize revenues, you also maximize profits in return. So should I write here the format? You're saying that these revenues from our P&L statement, revenues minus expenses, you get profit. Okay, if assuming it is 5,000 here, then you have 3,000. What you will get will be this minus that, which will be 2,000. Okay. So we're saying every time you increase your revenues, assuming now you're putting revenues at say 8,000. Okay, and the costs will not change. We are trying to confirm revenues essentially. Okay, what profit will it be? Saying profit will be big, will be maximized. Are you saying it's increasing? So increase in revenues is a good thing. You're maximizing profits. That's why it's favorable here. Actual is bigger than budgeted, hence favorable. For expenses, we're saying it's the reverse. We want to always reduce expenses for us to minimize. Okay. So for expenses, we want to minimize. Otherwise, if you increase expenses, then the profit reduces. So let me take an example of, okay, can I remove this? Yeah. So for expenses, assuming this is 5K and you're increasing your expenses, 4,000. The effect on your profit is that it will what? It will reduce. That's why we normally say that when your expenses are increasing or high, then your profit is reducing, hence adverse. Okay, I hope I've answered that well. Is the net contribution fixed or dear? I said that net contribution, gross contribution, profit, those are not items that have control on or flexed items. No. Okay, net contribution or gross contribution, you get them after getting the sales minus total cost. So you don't flex these ones. You don't flex gross contribution, don't flex net contribution, don't flex profit for the year. Okay, those are balances like gross profit. You don't flex gross profit. How you flex it is indirectly, that by dealing with sales and dealing with expenses, the figure you get after deducting expenses from revenues is a new figure automatically. So you don't flex it directly, like you say it's a variable, then you get cost per unit, then I'm apply by the level of activity. No, you don't do that. You just subtract it. Maybe I should show you that. Okay, let me show you that shortly. Okay, all right. Okay, so maybe to answer the other guy's question with an example, we're saying now, assuming these were the only variable costs that you have, our gross profit or gross contribution. Okay, you're saying it's not an item, it's not an expense, it's not an income. For it, it's just in a format for you to say that it is sales minus total variable production costs. Okay, that's how you get the contribution per unit. You don't flex it. So even here, something you say it is total sales minus total variable cost production variable cost. Get that? Okay, so for net contribution, gross contribution, profit, you don't flex them. You get them by saying total sales minus expenses. All right. So yeah. So guys, I beg to stop here unless you have any question. Tomorrow I intend to hold another, but I'm not sure of the topic. Probably pricing. Shall look at pricing tomorrow. Okay. If you have any question, please raise it now before I close in 5 minutes. As you didn't answer me, let me see your thing. Your question on fixed things. Is it must the fixed budget should be the same as fixed budget? Yes, like you're seeing here, fixed production was 1.2 and actual was 1.2. The flex must always be the same as the fixed budget. Okay, not actual, but the fixed budget which you're flexing. Okay, you have seen fixed selling price. It was 1.2. For flex, we're saying it's 1.1. Did I say 1.2? For fixed selling costs under fixed budget, it's 1.2. Under flex, it will be 1.1. Why am I saying 1.2? I know you've gotten the point. Yeah? They must be the same because we're saying change in level of activity, the 30 and 40 does not affect fixed costs. They always remain the same. So I hope I've answered you, Sumaya, regarding that. Please explain the fixed. Okay, so I've just explained. Is that the end of the budget question? Yes. As far as the analysis is concerned, once you have your variance, you have your comments, and you have your flex. That's the end of the question. Maybe I'll just read the part B of it. Thanks. All right. Justin, I hope we're together on the fixed thing. I've just said that for budgeted, it was, for the fixed budget, it was 1.1. So for flexing, it has to be 1.1 because it's a fixed cost. It has to be the same. Then you compare with the actual to get the variance. Okay, so just to maybe complete the question, what the question was all about. So at the end of the day, you get the operating profit. Yeah? Then to take you to the required bit. Okay, here they say that using the flexible budgeting approach, draft a budgetary control statement that is useful for control purposes. What we did there will get you 20 marks. Okay, flex, get the variance, new variances, and comment accordingly. Then part B says that managers often find themselves in a situation where they have to choose between incremental budgeting and zero-based budgeting. So I don't know if they've read some budgeting, but comment on this. Incremental budgeting, here, the way they prepare it is such that you have a previous budget or an old budget for previous period. Then you want to prepare a budget for this period. what we do is you remove what you call one-off transactions. Like maybe you had a construction, maybe you bought a car. Okay, those are one-offs. You don't have to buy a car again. Okay, so you remove them. Now, in removing them, now whatever is left, you add anything incremental to it. Okay, based on the level of activity that you're going to. Maybe if your sales are going to increase, you want to add more commission. If you're going to hire to expand in a way, maybe have another branch, you want to increase your cost of employees. Okay, that's what you call incremental. Now, for zero-based budgeting, what it does is it does not base on any old information. In a new period, new everything. If the previous month you had a budget, and now we are, okay, previous year, you had a budget, and you're in a new year now, we throw away the previous budget and graft a new one from zero. Every item on the statement or on the budget must be justified. Okay, that's what you call a zero-based budgeting. Okay, so this was part B. Whoever asked about is it done or something like that. All right. Thanks. All right, guys. Thanks for also attending, participating. I'll see you tomorrow. Okay. Good night. Good night. Okay.